All right, so capital property again, and I don't know why they start with well, I guess they do start with ordinary income property up here. So any asset that is not a capital asset, essentially inventory and receivables. I already went through a lot of this stuff to define it. And if you recall, so let's pull up a Schedule C. So anything that shows up here under income on the Schedule C, that's ordinary income. Okay, it's going to be taxed at ordinary tax rates. Any inventory that's sold is going to be taxed at ordinary tax rates. Whether you sell it now the difference is if you sell it in the ordinary course of business, it's going to show up here and it's going to show up on your cost of goods sold. If you sell it in bulk outside of the ordinary course of business, it's going to show up here under ordinary gains and losses. Still going to be taxed at the same tax rate. Nice thing is when it shows up here, it's not subject to self-employment tax. Same thing with receivables. All right, capital property, capital assets. And we already kind of went through a lot of this. Home owned and occupied by the taxpayer and the taxpayer's family, that would be considered a capital asset. Personal use or investment use types of property. They use the example of stocks and bonds here as well. Household furnishings, so your couch, your bed, your dining room table, all that stuff is considered a capital asset. And yes, believe it or not, if you sell it and you make a profit on it, you are supposed to pay tax on that. Car, your personal car, coin or stamp collections, gems and jewelry, gold, silver, and other metals. Now they list those separately because there's actually some special tax rates for those items. Okay, now, well, I mean, actually everything under this category, capital assets, has a special tax rate. Has some sort of different tax rate from ordinary income assets or property that is sold, ordinary income. All right, so it's gonna have a special tax rate. Some of them lower, some of them higher. But it's not gonna be dependent upon those marginal brackets that we talked about in chapters 1 and 2, okay? So it is any asset that is not held for sale to customers. So that'd be an item of inventory, right? Property used in a trade or business subject to depreciation. Well, that would either be a ordinary income property if we held it for less than 1 year, or 1231 trade or business property if we held it for more than 1 year. Copyright, again, they go with the copyrights. Accounts or notes receivable, that would be ordinary income. So these are the things that capital assets are not, okay? They are not. Real property used in the trade or business, that's gonna be section 1231 property. Commodities, derivative, financial instrument held by a dealer. Now we're getting specific as well. That's probably most likely all right, so that's a specific type of investment that would not be a capital asset. Hedging transactions, supplies used or consumed by the taxpayer in the ordinary course of a trade or business of the taxpayer. That would also not be capital property, okay? Musical compositions. Now, when we're talking about works of art, whether or not the individual created the work of art will determine how it's treated for tax purposes. If you created the work of art and sold it, that's ordinary income property. You created it through your own efforts and you sold it. So I painted a painting. It's a magnificent painting. I guess this is a popular place to be when there's no class in here. So I painted a painting and Brian bought it from me. And he bought it from me for $500. beautiful painting. I'm becoming a famous painter. Just imagine how much it's going to be worth when I'm dead. So Brian holds on to that painting that he purchased for $500. That $500 is ordinary income to me because I created it. To Brian, though, that is a capital asset. He waits until I'm dead and then he sells it for $10,000. Now he has a capital gain of $9,500. The difference between what he paid for it, the basis, it's not going to be adjusted. He's not going to depreciate it. There aren't any improvements that you'd make to a painting, except maybe you frame it or something like that. But the difference between what he paid for it and then what he receives for it. But it's going to be treated as a capital asset to him because he didn't create it. Okay, so it changes, even though it's the same asset, right? In my hands, it's ordinary income property. In Brian's hands, it's capital asset. Okay, so one difference there. And then trade or business property. Again, so 1231 assets. Depreciable or non-depreciable property, such as land, used in a trade or business, held for more than 1 year. So this is the distinction here. If it's held for more than 1 year. If it's held for less than 1 year, it's going to be ordinary income property. Tax rates are different, again, between these two types of property. If it's held for more than 1 year or held less than 1 year. Land purchased and held for investment is a capital asset. So again, you can have the exact same asset. The use of that asset is going to determine how it is taxed, how it's treated once it is sold. I have a piece of land that I'm holding for investment purposes. I'm not doing anything with the land. I bought it 10 years ago for $10,000. Now it's worth $100,000. I sell that piece of land for the $100,000. Now I've got a $90,000 gain. It's a capital asset, long-term capital asset because it was an investment to me. I sell it though to Sam because she's going to use it in her business. Now for Sam, it's going to be a 1231 asset. So if she sells it less than a year later, it's going to be, any gain is going to be taxed as ordinary income. If she holds it for more than 1 year, any gain is going to be treated as trade or business or 1231 income. Okay, so it's not, there's no real distinction between the types of assets. It's how they're used, right? Determines how they're then treated for tax purposes. All right. Most typical examples of 1231: machinery and equipment used in a business, business buildings, and business land. Okay, so those are the most common types. If it is disposed of within a year, it is treated as a short-term asset and considered to be ordinary income. If it's longer than a year, it is not ordinary income. It's treated as a long-term asset. Also, it does not include property that is considered inventory or artistic works. So, for example, if you had that painting that Brian bought and now I'm dead, he sells it for $10,000 to a business who then hangs it in their lobby. Well, that's not trade or business property to that business. It's capital gain property to them. Okay, it's not going to add any value to their business. Questions on the distinction between those three? We're going to go into more detail about how the gains and losses work.